All right, let's just get right into it. If you're a real estate investor or, a business owner, you probably know this feeling. Your business is doing great, cash is flowing, but when you go to the bank for a mortgage to buy that next property, you get a big, fat no. It's just this maddening paradox, right? Well, today we're going to break down exactly why that happens, and more importantly, what you can do about it.
I mean, it's the question that keeps so many smart investors up at night, isn't it? You've got the track record, you've got the equity, your net worth is solid, but the whole system just seems designed to shut you down. And you're probably sitting there thinking, is it me? But what if I told you the problem isn't you? It's not your success. The problem is the system itself.
And boom, here it is. This slide just lays it all out. On the left, that's your reality, a solid business with awesome, consistent cash flow. But on the right, that's what the bank sees. They are only looking at your tax returns. And because you've got a great CPA who's doing their job, you have all these smart write-offs that lower your taxable income. So the very things that make you a savvy entrepreneur are the same things that make you look like a huge risk on paper. Wild, right?
So let's pull back the curtain and talk about the root cause of all this. We're going to call it the conventional trap, because that's what it is. See, traditional financing, the kind from Fannie Mae and Freddie Mac, it just wasn't built for the modern investor or business owner.
And this right here, this is the key, the most important thing to get. You don't have an income problem, you have a structure problem. You're trying to jam your dynamic, real-world financial life into this rigid, one-size-fits-all box, and it just doesn't fit.
So let's break down exactly how this trap is set. First off, conventional loans are legally required to use your personal tax returns to qualify you. That means every single smart business write-off works against you. It's a penalty. And want to buy that property in an LLC to protect yourself? Good luck. It's super difficult, if not impossible. And then there's the biggest roadblock of them all, the one that stops growth dead in its tracks. 10. That's the number. The magic number where Fannie Mae and Freddie Mac just say, nope, you're done. It doesn't matter if you have perfect credit or cash flow coming out of your ears. Once you hit 10 financed properties, the conventional road is closed for business. Your portfolio growth slams to a halt, not because you're a bad investor, but because you've run out of their options. Until now.
Okay, so this is where we need to completely flip the script. The solution changes the entire game. Forget about financing the person. What if we could finance the property based on its own merits? It's a total shift in thinking. It's about financing the property, not the person.
And this is the tool that makes it happen, the DSCR loan. For a savvy investor, this is a total game changer. Your qualification is based purely on the rental property's ability to make money. Your personal W-2s, your complicated tax returns, all those business write-offs, none of it even comes into the picture.
This whole powerful idea really just boils down to one simple common sense question. That's it. Does the money coming in from rent cover the monthly bills for the property? The mortgage, taxes, and insurance. If the answer is yes, you're pretty much good to go. It's really that straightforward.
And hey, for those of you who like the math, it's this simple. The DSCR is just the monthly rent divided by the monthly expenses. And those expenses, that's what we call PITIA. Don't let the acronym scare you. It's just principal, interest, taxes, insurance, and any HOA fees. It's a clean, simple number that tells a lender instantly if the property can pay for itself.
Let's just walk through a really quick example so you can see it in action. Let's say the property you want to buy brings in $2,500 a month in rent. The total monthly payment, the whole shebang with taxes and insurance, is $2,000. So you just divide $2,500 by $2,000 and you get a DSCR of 1.25. Since anything over 1.0 means the property's making more than it costs, this deal qualifies. Simple as that.
Okay, so we've got the tool. We understand how it works. But a tool is only as good as the strategy you build around it, right? So let's talk about how this stops being just a loan and starts being your new scaling strategy, one that's designed to let you blow right past that old conventional ceiling.
Benefit number 1, and this is the big one: no tax returns required. All those smart deductions your CPA works so hard to find for you, they're not a penalty anymore. That whole tax return trap we talked about earlier, poof, gone. You just sidestepped it completely.
And benefit number 2? This just shatters that growth ceiling. Remember that 10 property limit? With DSCR loans, it just doesn't exist. There is no limit on the number of properties you can finance. So whether your goal is 12 properties or 120, this strategy lets your portfolio grow as big as your ambition.
And benefit number 3 is absolutely crucial for any serious investor. You can, and in fact, you're encouraged to, close in the name of your LLC. This is huge. It protects your personal assets and lets you structure your investments like a real business, keeping your personal finances totally separate from your rental portfolio.
So, who is this strategy absolutely perfect for? Well, if any of this sounds like you, then listen up. If you've already slammed into that 10-property wall, if you're self-employed and you have a ton of write-offs, if you need to close deals fast without all the paperwork, or if you're just trying to buy properties the right way in an LLC, this was literally built for you.
And this is the mindset shift we need to have. It's so important. Too many people think of a DSCR loan as some kind of last resort option. It is not. It's a primary, strategic scaling tool for smart investors who get that the old system just doesn't work for them anymore. So the real question isn't about the loan, it's about you. Are you ready to stop letting that old system dictate how fast you can grow?